Every day, businesses make the same calculation. The customers are willing to pay more, charge more. It's one of the oldest rules in business. Fuel prices rise. Airlines add fees. Streaming services increase subscriptions. Restaurants quietly shrink portions. Shareholders expect it. Wall Street rewards it. And executives call it growth. So why would a company do the opposite? Why would one of America's largest retailers repeatedly leave money on the table, even when customers were ready to spend more? At first glance, it doesn't make sense. A public company exists to earn profits. Higher prices usually mean higher profits. Higher profits often mean happier investors. That logic has shaped corporate America for generations. Yet inside enormous warehouse stores with concrete floors and towering shelves, a different philosophy quietly took root. One that challenged a simple assumption. Maybe the fastest way to make more money isn't to ask customers for more. Maybe it's to give them one less reason to doubt you. That idea helped transform Costco from an ambitious warehouse retailer into one of the most trusted companies in America. Not because it had the lowest prices on everything, but because millions of people gradually stopped asking a question that almost every retailer forces customers to ask. Am I getting a fair deal? That wasn't an accident. It was the result of one deliberate decision. A decision that looked conservative, sometimes irrational, and occasionally expensive. But over decades, it became one of the most valuable competitive advantages in modern business. This isn't a story about discount retail. It's a story about trust, and why protecting it can be more profitable than chasing the next dollar. Walk into almost any large retailer, and you're surrounded by choices. Different brands, different promotions, different prices. Bright signs compete for attention. Limited time offers create urgency. Loyalty programs promise savings. Coupons reward patience. The experience often feels like a negotiation. Customers compare, calculate, question. They wonder whether waiting another week might produce a better deal, or whether another store has quietly beaten today's price. Over time, that uncertainty becomes part of shopping itself. Most businesses accept it as normal. Costco didn't. From the beginning, the company pursued something more ambitious than low prices. It wanted to eliminate hesitation. The goal wasn't simply to sell products. It was to create confidence. Confidence that the price on the shelf represented genuine value. Confidence that the company wasn't constantly searching for new ways to extract a little more from every visit. That confidence didn't come from advertising. It came from discipline. Costco developed a reputation for limiting markups on most merchandise instead of pushing prices as high as the market might allow. In many cases, that meant accepting smaller profits on individual sales than competitors might consider reasonable. On paper, it looked like money left behind. But Costco wasn't measuring success one transaction at a time. It was measuring something much harder to see. What happens when customers stop feeling like they need to defend themselves? Because every moment a shopper spends wondering whether they're being overcharged is a moment of friction. And friction quietly erodes trust. Most companies focus on maximizing today's sale. Costco increasingly focused on maximizing tomorrow's return visit. That shift changed everything. Because once customers believe a company consistently acts in their interest, their behavior changes. They stop comparing every item. They stop second-guessing every purchase. And eventually, they begin trusting the company with a larger share of their spending. It sounds simple, but for a publicly traded company, it creates a difficult question. If customers already trust you, why not slowly increase prices anyway? Would anyone even notice? Many companies have asked exactly that question. Costco chose to ask a different one. What happens if we never give customers a reason to start wondering? That question would shape pricing decisions, supplier negotiations, executive priorities, and even conversations inside boardrooms. It would also create tension with one of the most powerful forces in corporate America. Because while customers value patience, financial markets often reward immediate results. And before long, those two worlds would collide. Every successful business eventually faces the same temptation. Success creates confidence. Confidence creates opportunity. And opportunity invites one simple question. Could we charge just a little more? For many companies, that's the beginning of a familiar cycle. Prices inch upward. Margins improve. Quarterly earnings look stronger. Investors applaud. No single increase seems dramatic. But over time, something changes. Customers begin paying closer attention. The relationship shifts. Instead of assuming fairness, they start comparing prices again. They hesitate. They second-guess. Trust, once taken for granted, becomes a calculation. Costco understood something that doesn't appear on a balance sheet. Trust compounds slowly and disappears quickly. That made its pricing philosophy unusually difficult to defend. Unlike privately owned businesses, Costco answers to shareholders. Public markets reward growth. Analysts study margins. Investors compare quarterly performance. Every earnings report becomes another opportunity to ask why profits couldn't be just a little higher. On paper, the argument sounded reasonable. Costco welcomed millions of loyal members every year. The stores were busy. Its reputation was strong. Surely customers would tolerate modest price increases. Many probably wouldn't even notice. From a purely financial perspective, the math looked attractive. Across thousands of products and millions of transactions, even small increases could translate into enormous additional revenue. For many retailers, that would have been an obvious decision. Costco saw something else. Management believed every unnecessary price increase asked customers for more than money. It asked them to surrender confidence. Once shoppers begin wondering whether a company is quietly maximizing every opportunity to charge more, the relationship changes. The customer becomes cautious. The company becomes transactional. And rebuilding confidence is far more expensive than preserving it. That philosophy shaped conversations far beyond pricing. It influenced supplier negotiations, product selection, store operations, even executive priorities. Costco wasn't trying to win one shopping trip. It was trying to earn the next 100. That required patience. Patience is easy to celebrate when business is booming. It's much harder when markets demand faster results. History is filled with companies that discovered how easy it is to increase prices, and how difficult it is to reverse the damage once customers feel taken for granted. Costco chose a slower path, not because higher prices were impossible, because leadership believed something more valuable than a higher margin was at stake. Reputation. Unlike revenue, reputation doesn't appear as a line item on an income statement. Yet it quietly influences every future sale, every membership renewal, every recommendation between friends, every decision to drive past another retailer and head toward a Costco warehouse instead. That invisible asset became one of the company's greatest strengths. But there was still a problem. Trust alone doesn't explain why Costco could afford to keep margins lower than many competitors. There had to be another engine powering the business. And once you understand where Costco really makes its money, its entire strategy begins to look less like generosity and more like one of the smartest business systems ever built. Here's the assumption almost everyone makes. Costco makes money by selling products. It sounds obvious. Customers walk into a warehouse. They fill giant shopping carts. They buy televisions, groceries, furniture, electronics, and clothing. The products seem to be the business. But that's only half the story. The real engine is much quieter. Before customers buy anything, they've already made a decision. They've paid to belong. That annual membership changes the relationship. Most retailers earn your trust after you've spent money. Costco asks for trust first. That sounds risky. In reality, it changes almost everything. When someone pays to become a member, they're making a small bet. They're betting that over the next year, Costco will consistently deliver enough value to justify renewing. That means every visit matters. Every price matters. Every shopping experience becomes another opportunity either to strengthen that belief or weaken it. Suddenly, the business isn't simply selling products. It's protecting a promise A promise that members will continue feeling the membership was worth buying. That changes how leadership thinks. Instead of asking, how much profit can we earn from today's customer? The better question becomes, will today's experience make them come back next year? Those are very different businesses. One optimizes transactions. The other optimizes relationships. Costco chose the second. Its pricing discipline begins to make sense once you view the company through that lens. Every time a member walks out believing they received honest value, the membership itself becomes more valuable. Not because of marketing, because of experience. Trust stops being an abstract idea. It becomes something customers repeatedly confirm with their own eyes. That confidence spreads. Families recommend Costco to friends. Coworkers talk about unexpected bargains. Members return for products they never planned to buy because they've developed confidence in the pricing philosophy itself. Eventually, customers stop evaluating every individual item. They evaluate the relationship. That's a remarkable shift. Most businesses fight to win every sale. Costco works to eliminate the need for constant persuasion. The membership model creates another advantage. Because a significant portion of revenue comes from memberships, the company doesn't have to squeeze maximum profit out of every product on every shelf. That flexibility allows management to think differently. They can protect value on merchandise because they're protecting something even larger, the customer's willingness to renew. Viewed this way, low prices aren't charity. They're an investment. Every honest deal strengthens the next renewal. Every renewal strengthens the business. And that creates a cycle competitors struggle to copy. Because matching Costco's prices without matching its underlying business model often means accepting thinner profits without the same long-term benefit. What appears simple on the surface is actually a carefully connected system. Membership builds commitment. Commitment encourages repeat visits. Repeat visits increase purchasing. Consistent value builds trust. Trust drives renewals. Renewals strengthen the business. The cycle begins again. That's why Costco's strategy isn't really about selling products more cheaply. It's about making trust economically sustainable. And that's a much harder advantage to replicate. Because competitors can copy prices. They can copy store layouts. They can even copy product selection. But copying trust requires years of consistent decisions that customers experience for themselves. One promise, kept again, and again, and again. Over time, that becomes a competitive advantage no advertising campaign can purchase. But every successful business model eventually faces a difficult test. The true measure of a principle isn't whether it works when conditions are easy. It's whether leadership still follows it when doing so becomes expensive. For Costco, that moment would arrive more than once. And each time, the company had to decide whether protecting trust was still worth the cost. It's easy to talk about values when they don't cost anything. The real test comes when keeping a promise becomes expensive. For Costco, those moments arrived again and again. Suppliers raised prices. Transportation costs increased. Inflation pushed operating expenses higher. Every change created the same pressure. Raise prices. Protect margins. Keep investors satisfied. From the outside, the decision looked obvious. Inside the company, it was more complicated. Leadership understood something many businesses discover too late. Customers rarely remember the exact price they paid for one item months ago. But they remember how a company made them feel over years. Were they treated fairly? Did the company keep its word? Could they shop without feeling manipulated? Those questions shape loyalty far more than a temporary discount. Costco repeatedly chose to protect that feeling. Sometimes that meant accepting lower margins on products customers associated with the company's promise of value. The now famous $1.50 hot dog and soda combo became a symbol of that philosophy. Not because it generated exceptional profit, but because it reinforced a message customers already believed. The combo wasn't the strategy. It was evidence that the strategy was real. It told members without a single advertisement, if we'll protect the value of something this visible, we'll probably protect the value of everything else too. That's how trust works. People don't judge promises by speeches. They judge them by repeated actions. Every time Costco resisted the easiest path to higher short-term profit, it was making another deposit into what might be called a trust account. Unlike a bank account, customers couldn't see the balance, but they could feel it. One visit at a time, one renewal at a time, one recommendation at a time. Over decades, those invisible deposits became remarkably valuable. Competitors could lower prices for a weekend. They could launch aggressive promotions. They could advertise bigger savings. But trust isn't won over a holiday sale. It's earned through consistency. And consistency is expensive, because every business eventually faces moments where breaking a principle would immediately improve the numbers. That's why principles matter. Not when they're easy, when they're costly. Costco's leadership understood another uncomfortable truth. The fastest way to damage trust isn't one dramatic mistake. It's a series of small decisions that customers barely notice individually. A hidden fee, a shrinking package, a price increase that feels opportunistic. Each decision appears insignificant. Together, they quietly change how customers think. Eventually, shoppers begin asking the question Costco wanted to eliminate from the very beginning. Am I still getting a fair deal? Once that question returns, rebuilding confidence becomes incredibly difficult. That's why Costco treated trust less like a marketing campaign and more like infrastructure. Invisible, expensive, essential. The remarkable part is that this philosophy didn't just influence customers. It shaped employees, suppliers, managers, and even investors who understood that Costco wasn't optimizing for the next quarter. It was optimizing for the next decade. That's a very different way to run a public company. And it points to a lesson much larger than retail. Because every organization, whether it's a global corporation, a small business, or an individual professional, eventually has to decide what it wants people to remember after every interaction. The transaction, or the relationship. Costco made its choice decades ago, and that choice continues to shape millions of decisions every year. But perhaps the most surprising lesson has nothing to do with warehouses, or memberships, or pricing. It has to do with something almost every business misunderstands: what customers are actually buying. At the beginning of this story, we asked a simple question. Why would a successful public company repeatedly choose not to maximize short-term profit? By now, the answer looks very different. Costco wasn't refusing to make more money. It was choosing how to make it. Most businesses think of trust as a consequence of success. Build a great company, and customers will eventually trust you. Costco quietly reversed that equation. Treated trust as the starting point, not a reward, not a slogan, not a marketing campaign, an operating system. Every pricing decision, every supplier negotiation, every membership renewal, every promise kept. They weren't isolated business choices. They were investments in something no competitor could copy overnight. Confidence. Because the most valuable customer isn't the one who spends the most today. It's the one who returns without hesitation tomorrow. That's the difference between a transaction and a relationship. A transaction ends the moment payment is complete. A relationship compounds every time expectations are quietly met. Over the years, Costco built a business where millions of people stopped asking, "Am I getting a fair deal?" And once customers stop asking that question, something remarkable happens. Shopping becomes simpler. Loyalty becomes natural. Recommendations become genuine. Growth becomes more predictable. Not because the company demanded trust, but because it earned it repeatedly. That's why Costco's greatest competitive advantage isn't hidden in a warehouse. It isn't a membership card. It isn't a famous food court. It isn't even low prices. It's the confidence customers carry with them before they walk through the doors. You can't manufacture that confidence with advertising. You can't buy it through acquisitions. You can't build it with one successful quarter. You earn it through thousands of decisions that most people never notice. And perhaps that's the lesson hidden inside this story. The strongest companies aren't remembered for the decisions that made them the most money. They're remembered for the decisions that made people believe in them. Long after prices change, products disappear, and competitors come and go, trust remains, keeps customers returning, employees believing, investors patient, and businesses resilient when conditions become difficult. Maybe that's why Costco's strategy has never really been about keeping prices low. It's been about keeping doubt low. Because every time doubt enters a relationship, value quietly leaves. Every billionaire realm story begins with a business decision. But beneath every great business decision lies a principle that reaches far beyond one company. Tonight, that principle was trust. The next time you walk into a business that seems unusually successful, don't ask only what it's selling. Ask yourself something deeper. What belief has this company convinced people to stop questioning? The answer may reveal its greatest competitive advantage. And it may change the way you see business forever. Because behind every enduring empire, there is one invisible decision that everyone else underestimated.